Hi everyone, we are now going to be looking at Chapter 8 and stock, the different types of stocks and the characteristics. So specifically, we'll be identifying the basic characteristics of one type of stock called preferred stock. We'll show you how we value preferred stock. Then we're going to identify the basic characteristics of common stock and how we value that, and how we calculate a stock's expected rate of return. So let's get started with preferred stock. So when you hear that word preferred, you think preference, right? And that's what preferred stock is. It is ownership in the business, okay? So stock is stock. That it's equity. It represents owning part of the business. But preferred stock has a lot of characteristics of a liability, meaning just like a bond is required to pay interest, preferred stock is basically required to pay a set dividend. And usually, if that dividend isn't paid in a certain year, it will accumulate going forward until it is able to be paid. So you're almost guaranteed a dividend on a preferred stock at some point. Maybe not annually, because dividends are not required to be paid each year. But if a year is passed on a dividend, those dividends that were not paid in a year will accumulate until a dividend is declared by the board of directors and the money is paid. Now, like common stock, preferred stocks have no maturity value though. So there's no maturity date. Failure to pay dividends does not lead to bankruptcy. So, like I said, it is the board of directors of the corporation that declare a dividend and actually pay out a dividend to the shareholders, whether they're preferred or common shareholders. But they're not required to pay it each year. Another thing is that dividends paid by a corporation are not tax-deductible expenses like interest is. The characteristics of a bond, like we were saying, it's a lot, oh, you're going to get a fixed amount. And here it is. Dividends are fixed in amount, either as a dollar amount or as a percentage of the stock's par value. So some of the characteristics related to preferred stock, you could have multiple series of them. So it's all based on the corporation. If the corporation wants to sell a couple different types of preferred stock or series, they can, if they have permission from the state that they're incorporated in. And these different series might have different dividend rates or par values. It depends. Preferred stocks claim on assets and income. What does that mean? Well, preferred stockholders always receive their dividends and assets first. So when a board of directors declares a dividend, the corporation will look to see how much money do we owe, do the preferred stockholders, are they entitled to? So this year's dividend, most definitely. But you see that cumulative dividend? That could mean dividends in the past that were not paid yet because the board of directors did not declare a dividend. So what happens is preferred shareholders get all of those dividends first. Then, so they always receive their dividend first. Then common stockholders get any leftovers if there is. Cumulative dividends is what we were just talking about. If a dividend is not declared in a year, the preferred shareholders can say, hey, I want that dividend. So since you're not going to pay it to me this year, add it to next year's until there's a dividend actually declared. There's protective provisions within preferred stock. Oh, and by the way, going back to assets, if the company goes into liquidation, meaning they're going to close, doesn't mean they're going bankrupt. Maybe they just decide we're going to close. They sell off the assets, pay off the liabilities. The money that's left over, the preferred shareholders get their piece of the pie first, and they already know on their stock certificate how much they will receive per dividend in a liquidation. Sometimes preferred stock can be converted into common stock. And there could also be retirement provisions, meaning, right on the stock certificate, it could define how the preferred stock could be purchased back by the corporation and not sent back out into the public. So again, if a company desires, it can issue more than one series of preferred stock, and each series can have different characteristics. Claim on the assets. The preferred stock has priority over common stock with regard to claim on assets in the case of bankruptcy or liquidation. It's not always bankruptcy. The claim on income, they also have a priority with dividend payments. The preferred stocks are safer than common stock, but riskier than bonds. Okay. All right, sorry about that. I needed to take a look at something. Cumulative feature, if it exists. Most preferred stock have this cumulative feature because it makes it marketable, meaning any past unpaid dividends be paid before any common stock dividends are paid. Not declared, but paid. Protective provisions. I didn't talk about this. This generally allows for voting rights in the event of non-payment of dividends. Normally, preferred shareholders do not have the right to vote, but if the company isn't paying dividends, they may have a right during that time period, or they restrict the payment of common stock dividends. If sinking funds, so savings account payments, are not met, or if the firm is in financial difficulty. So it's just a way to protect the preferred shareholder to make sure they receive their money, because preferred stock is less risky than common stock, and that's why we have these protective provisions. Convertible preferred stock, again, can be converted into a predetermined number of shares of common stock. That's usually right in the stock certificate. And there you go, some statistics. As 1/3 of preferred stock issued today is converted. So at any point or during a certain time period, the owner of the preferred stock could hand it into the corporation and ask for common stock in its place. Again, the retirement provisions. Although preferred stock has no set maturity associated with it, issuing firms generally provide some method of retiring the stock, such as a call provision or sinking fund provision. So let's talk about both of these. The call provision is this. On the stock certificate, it allows the corporation to repurchase the preferred stock at certain prices during a given time period. We were just talking about that. And then at that point, the corporation may just rip up the stock certificate and say, we don't have this preferred stock anymore. A sinking fund provision requires the firm to set aside an amount of money for the retirement of its preferred stock. So the corporation may need to do that because maybe the shareholder can send the stock back and say, give me my money. It all depends on the characteristics of it. So those are the major types of characteristics associated with preferred stock. Let's see how we value it. So the economic or intrinsic value of preferred stock, so what is it worth today? It's the present value of all the future dividends. The present value of all the future dividends. So we calculate the value by taking our annual dividend divided by the rate of return we require. So here's our formula. Preferred stock equals stock value equals annual dividend divided by required rate of return. So assume PG&E preferred stock pays an annual dividend, and be careful of that. Make sure it's for an entire year. And the investor wants a rate of return of 5%. How much are they willing to pay for that stock? $25. $1.25 divided by 5%. That's how much they're willing to pay for that preferred stock. Pretty straightforward. Now we're going to go into common stock and the characteristics and valuing that. So common stock, and I always think of my one student who said, okay, so common stock is like the peasants or the commoners. And that's exactly right. Preferred stock receives preference for a lot of things. Dividends, liquidation, money, they get to convert. They may accumulate their dividends. But common stockholders are pretty much getting whatever's left. So common stock is a certificate that indicates ownership in a corporation, just like preferred stock. But it doesn't have the guarantees like preferred stock. When you buy a share, you buy a part or share of the company and attain ownership rights in proportion to your, quote, share of the company. Common stockholders are the true owners of the firm. Bondholders and preferred stockholders are viewed more as creditors. Although preferred stockholders do not require repayment or have a maturity date, it's usually the common stockholders that are looked at as true owners. They're not requiring anything. There's a great picture of a sample stock, and it says how many shares you own, who owns it, the name of the company, and when it was issued. So, when it comes to income, common shareholders have the right to leftover income after the bondholders receive their interest payment, and preferred stockholders have received any of the dividend declared. So they get whatever's left. Residual income can be paid in the form of dividend or retained within the firm and reinvested in the business. So we're looking at this residual income from a very high level, net income. Okay, so net income is owned by two distinct parties. It's owned by preferred shareholders, and they already know the dollar amount of the net income that has been promised to them this year because it's their dividend, and they already know their dividend. The remaining part of net income is for the common shareholders. So we have net income that's really the owners, okay, but only a part of net income may be declared as a dividend. So the part that is declared as a dividend will be paid out to those shareholders, preferred and common, and then a part of the net income will remain in the business in an account called retained earnings. Retained earnings. And these retained earnings are what is used to make the company better and bigger, reinvested. The claim on the residual income implies there's no upper limit on income. But it also means that on the downside, shareholders are not guaranteed anything and may have to settle for zero income in some years. So as I said, a corporation is not required to pay out any of the net income as a dividend. There's no law that says they have to. So you need to know that going in as a shareholder. Common stock has a residual claim on the assets in the case of liquidation. Again, if the company sells its assets, sorry about that, I was interrupted. So generally, if a bankruptcy occurs, the claims of the common shareholders are not typically satisfied. Why? Because if they're in bankruptcy, there's not enough assets to even pay off the liabilities normally, or just enough. And if there's preferred shareholders, they're already entitled to liquidation proceeds right on their stock certificate. So if there's any money left over after paying off the preferred shareholders after all the liabilities are paid, that's what the common shareholders would get. So you can see they really are the peasants, right? The liability of the shareholder, though, to the corporation is limited to the amount they purchased the stock for. That's one of the beautiful things about being incorporated. The owners don't have personal liability. So this characteristic helps the firm in raising funds. Common shareholders normally have the right to vote. So the majority of shareholders generally vote by proxy, or somebody else will vote in their place. Proxy fights are battles between rival groups for proxy votes too. But the common shareholders are entitled to elect those board of directors. Now, if you're like, board of directors, I know what you're talking about, but I'm not really sure what their function is. Well, the board of directors is the liaison between the company's owners, the shareholders, and the company itself, the company's management. So the board of directors is acting on behalf of the shareholders to make sure the company is producing what the shareholders are required or are requiring of the corporation. So the board of directors will hire the CEO, the CFO, the major levels of management. They'll declare dividends. They'll help to decide if more stock needs to be sold or bonds need to be issued. So they're in those very high-level financial decisions, and the owners elect them to represent them. The shareholders also have to approve any change in the corporate charter or that permission slip from the state. So voting for directors and charter changes occur at the corporation's annual meeting. So if you are an owner of common stock in a corporation, you'll always receive a notification about it with majority voting. So each share of stock allows the shareholder one vote. Each position on the board is voted on separately. With cumulative voting, each share of stock allows the stockholder a number of votes equal to the number of directors being elected. So it's just different types of voting rights. In the real world, shareholders do not really pick the board, rather they simply select from a list of nominees chosen by the management. So are you nominating someone you know personally? No. There's usually a predetermined list of people, and then you vote the ones in that most meet what you feel the corporation should be accomplishing. So this does open the door for management-favored boards, which may not always be in the best interest of the shareholders. So that's the reality of it. Common stockholders have a preemptive right. What does that mean? They have a right to maintain a proportionate share of ownership in the firm when new stock is being sold. So if a shareholder currently owns 25% of the common shares that are sold, they have a right to purchase 25% of the shares when more are being sold of that type of stock, so that they maintain that 25% ownership overall. So these rights are issued in the form of certificates. They give shareholders the option to buy new shares at a specified price during a 2 to 10 week period. So a stockholder does not have to take advantage of these. These rights can be exercised, so they can say, oh yeah, I want to maintain my ownership percentage. I'm going to buy that stock. Or they could say, nah, I don't care about that. I'm going to sell these rights to somebody else. So there's a market for these rights. I'm going to sell the right for someone to buy these shares of stock, so they'll be the owner when they buy them. Or they could just put them in a drawer and forget about them or throw them away, just to let them expire. So those are the characteristics of common stock. Let's look at valuing it. So like bonds and preferred stock, the value of common stock is the present value of expected future cash flows. But unlike preferred stock, we don't have a fixed dividend amount, nor a guarantee of it. So it's much harder to value it. So unlike preferred stock, common stock dividend is not fixed. And dividend patterns may vary. One year you may not get anything, the next year 50,000, the next year, 20,000. but dividends do generally tend to increase as the corporation's earnings grow. So there is a pattern here. So because of that, okay, let's just do this slide, sorry. So how a company grows through infusion of capital, so by borrowing or issuing new common stock will help the corporation receive more money and be able to earn more earnings. They could do through internal growth, where they keep the profits in the business, and those retention of profits, the money in the company, helps the company to grow. Okay, so internal growth directly affects the existing stockholders and is the only growth factor used for valuation purposes. So here's what internal growth is. G being growth equals return on equity times the percentage of the profits that are retained by the company. We call that the profit retention rate. So the growth rate of future earnings. So remember, there's a correlation. If the future earnings grow, the common stockholders' equity will grow, or the dividends. Return on equity is determined by taking how much the net income is for the company and dividing it by the common stockholders' book value. So that's the ROE. And then the percentage of profits retained is determined by taking, here's how much profits we had overall, how much of it didn't we pay out as a dividend? So let's take a look. There's our formula again. So the common stock value, well, it's a different formula actually, sorry. The common stock value is the dividend amount in year one. So that's an entire year, divided by the required rate of the return of the investor, minus, from the previous slide, the growth rate. So we showed you how to get growth rate, return on equity, times percentage of profits retained. Okay, now we use the growth rate in our calculation of determining common stock value. So consider the valuation of a common stock that paid $1 dividend at the end of the last year and is expected to pay a cash dividend in the future. Dividends are expected to grow at 5%, and the investor's required rate of return is 10%. So D1, and this is important, you just don't say, oh, that dollar is D1. No, that's last year's. That's D0. We want to calculate this year's value. So we take that $1 times 1 plus the growth rate, which is 5%. So D1's dividend will be $1.05. That's the expected growth rate. That's the expected dividend in the first year. Divide that by 10% required rate of return minus growth rate of 5%. So $21 is the value of this stock. That's what this investor is willing to pay. The expected rate of return on stockholders. What is this? The expected rate of return on a security is the required rate of return